All right, we're back with the new American Realist Show. I have Nathan Lewis with me today. St. Patrick's Day is today, so happy St. Patrick's for those who celebrate. Thank you for taking your time today, Nathan, to coming on the new Realist Show. We're going to keep it short and sweet. A lot going on in the world. You are the editor for the Polaris letter, correct? And you are a book publisher as well. Can you tell us a little bit about yourself before we continue?
Yes. So I've written 5 books about monetary economics for the most part, economic topics. I kind of come from the supply side school, the Art Laffer, Larry Kudlow, Steve Forbes kind of side of economics. And they've actually always been gold standard fans. So, but I thought that was in their low tax message, I was sort of neglected. So my first 3 books are what I call the gold standard trilogy, 3 books about economics, the gold standard. Which is the way we did things in the United States for almost 2 centuries until 1971, but is very poorly understood today, even among those people who call themselves experts. So I thought this had to be remedied. But come from kind of a Wall Streety background. I actually have run 2 hedge funds in the past. Did pretty well for a while there. And then I wrote 2 more books recently. One is called The Magic Formula, came out in 2019. It's more of a broader kind of supply side themed book of how to make economies work well. And then last year, I co-authored with Steve Forbes of a book about inflation, and it has a lot of stuff in there that I think the so-called experts still need to kind of brush up on. And I also have, as you mentioned, a retail newsletter. It's aimed at the 401k investor. People often ask me, "What are you doing with your money?" And so I let them know what I'm doing. So that's where I'm coming from today. Thanks a lot.
Thank you. And my first question is going to be just based on the Fed Reserve. And what do you think they will do next week? I believe is the next meeting where they're supposed to go 25 basis points. Some people say it's going to be 50, some say 0. And what is your outlook for the next, I guess for the next several months, starting from now? What do you think is going to happen? Go ahead and please let us know. What do you see happening?
Well, the Fed meeting next week might not be the most important thing in terms of their interest rate policy. I would guess they're going to sort of do what the ECB did, which is sort of execute their prior plan that suggests 25 basis points to me, and then leave the future kind of up to future developments. But the more important thing is what they've done this week before their meeting, which is they opened the discount window aggressively, loaning money to banks, which need the money to meet outflows, and that's pretty reasonable. They did that in 2008, also, although the amount that they loaned in 1 week, in the last week, is as much as the largest total balance in 2008. Now, if you remember 2008, it was like a economy-wide banking crisis. They've already matched that level. So it'd be interesting to see where that goes. They added about 300 billion, I think, of essentially created money out of nothing. So the central bank, Federal Reserve's balance sheet has suddenly turned from being quite contractionary and conservative, let's say, to being pretty aggressively expansionist again, as we've seen in past crises times, 2008, 2000, and 2020. And it's an open question where that's going. There was a recent guess from Morgan Stanley that this might go from 300 in a week to 2 trillion total within a few months, let's say. I don't know, which would be a lot. and they could kind of manage other parts of their balance sheet but I think it's clear that they're moving to an expansionary stance, and gold is doing now what we saw happen at those times too, which was in the first instance, creating more money. It's essentially what they're doing. They don't use printing presses anymore. It's all digital, but they're sort of printing money, creating money. It tends to be a currency negative, and that's the first impulse here. And probably, I would guess, pretty good chance it's going to continue unless there's some other factor that comes up. I don't think the Fed wants the value of the dollar to decline, which is essentially what a rising gold price means. But they might not, other things have taken priority, let's say. This is the pattern that we've seen in the past.
Got it. You mentioned something I want to interrupt here just for a minute, because from your book, you have a quote, since you mentioned when you see basically gold prices rise, then you know what's happening to your purchasing power, right? As you need more currency units to buy certain things, as they're devaluing, that's what the gold price going up is telling you. So you have it from your book. I wanted to have you elaborate a little bit more on this. This is quote from Nathan Lewis himself. If you want to know what's happening, value of the dollar, gold is where you would look first when the price, if you want to know what's happening to the value of the dollar, gold is where you should look first when the price of gold rises. In other words, when more money is needed to buy an ounce of gold, that usually means that the dollar value has decreased.
Right. And that is a principle that has been true for hundreds and hundreds of years. Why did we base our money on gold in the past, even when we used paper banknotes and stuff like that? It wasn't just superstition. It wasn't like, oh, we like yellow, shiny things. It's because gold has tended to remain stable in value, in monetary value. And people said this, right? That this used to be what everybody, common conventional wisdom. And it's a economists of my camp tend to assert that gold still has this quality. It's still basically stable in value, maybe not perfectly stable, but basically stable in value. And so the dollar is a floating fiat currency. Its value goes up and down. Nobody's going to deny it. So the question is, how much is its value going up and down, right? And of all the things that we have, gold is the best indicator of that. So if it takes more dollars to buy an ounce of gold, it's a lot like it takes, we use the example in the book, it takes more Mexican pesos to buy a dollar. What does that mean? It means the Mexican peso is going down. Usually that's what that means, right? It takes more dollars to buy an ounce of gold means the value of the dollar is declining. And you can argue about how accurate this is or whether one day's movement really means very much. But if you just look at what's happening in 2020 or now, yeah, the Fed turns around, becomes really expansionist, creates new money out of nowhere to meet various crisis difficulties. It's not very surprising that our floating fiat currency anchored to nothing might sink in value under those conditions. And that is more or less what we've seen in the last couple of days as people kind of project where this is going, right? What's the Fed going to do over the next 6 months? Well, it looks like the old game plan, the old fighting inflation game plan is going to be sidelined for now.
Got it, because you mentioned basically the way I put it in my perspective here, quantitative tightening that started in March of 2022, they started tightening, right? You mentioned in 1 week, they basically lost all of that tightening, whatever they were doing with shrinking the balance sheet. All of that was gone now, as they are coming back to easy money, meaning quantitative easing. They are coming back to that, and this is where I believe you were talking about in your Kitco interview, which is where I found out about you about 7 months ago. You painted the picture exactly what's happening today. That's why I was very excited when you decided to come on the show, because like I said, you said transitory. It is not. I know some other people said the same thing, but you were very confident that you were spot on that call. That's exactly what happened. So we are back to easy money. They're not going to shrink the balance sheet the way it looks. That's what I believe based on what you said. And this would just help gold to go up in value, correct?
Yeah, that does seem to be the way things are going. And we've seen this before in the Federal Reserve the last 20 years. They've done stuff like this. I have to have a caveat. We don't have a perfect crystal ball. The Fed has done, pulled curveballs on us in the past. For example, they had this big reverse repo thing that they started. I guess it was in 2021, which essentially sucked money out of the system. So they were worried about inflation. They're getting a lot of heat about inflation. So they said, well, let's take some money out using this new tool, which never really existed before. And everyone's kind of like, whoa, I didn't know that was on the playbook, right?
Mhm.
So, I want to have some caveats that we can't be certain, but yes, I think in the environment of bank crisis, which we are in, and which I think will probably continue, like just as Morgan Stanley said, if we get a 2 trillion expansion through the discount window, which might be in a few weeks, that is we're clearly back on the easy money plan, I would say.
Got it. Yeah, you mentioned the repos. Now it almost kind of like reverse repo, because we started with the repo in 2019, correct? Isn't that
Right,
when
yeah.
we started introducing it? And this is where I started to do a little bit more videos and telling people I thought there was a huge sign to get slowly out of the fiat system as much as you can and start getting into physical assets. I'm a big component of holding hard assets in your possession, whether you prefer, silver or gold or whatever it is. And I'm also all about soft commodities, having your own food. We grow our own food here at the ranch, having cattle, having chickens, stuff like that as things are getting out of hand. So with all that being said, are you more into, this would be my last question. I don't want to take up too much of your time on St. Patty's Day. What do you think now when it comes to equities for precious metals? Are you more on, I want to be more in precious metals equities? What is the ratio just for that portfolio compared to physical holding in your possession when it comes to gold, silver, and possibly, I don't know, platinum, palladium? If you can give us a rundown for a couple of minutes on that.
Yeah, I've tended to bias toward simply the metals. Whether you use an ETF or you want to take physical delivery, I think every individual investor should own a little bit of physical precious metals just to see what it's like, right? It's not all digital. You're not like, just clicking your mouse on your whatever, Charles Schwab account. You actually own something in your hand. I think that does something to your head. And so in the precious metal space, I have skewed toward the metals themselves. Gold, I think silver is wildly volatile, but probably has some upside relative to gold ahead. I like platinum also for the same reasons. You have to stomach a lot of ups and downs in those, but I think there's potential. I think you get paid for that. Gold equities, I've they tend to have opportunities from time to time, mostly as kind of like value plays where for some reason something's trading at 20% of its reasonable value, 30% of its reasonable value. And there have been a lot of opportunities along those lines. However, the industry as a whole has kind of been a capital destroyer and has underperformed bullion for a long time. And I kind of sense that's kind of an industry-wide trend that will continue. So within the equity space, I've tended toward the royalty companies.
Okay.
I think Franco-Nevada will continue its long history of success, and if you can buy the shares at a local dip, because they do go up and down from time to time, you might do pretty well there. And some of the other royalty guys with some same basic principle. Some of the others are a little cheaper. They don't have Franco-Nevada's fantastic track record. So that's been my two focuses: metals themselves, especially in this environment of potential bank difficulties and potential, I don't know, CBDC rollouts or something like that soon.
So you mentioned
Physical metal is interesting.
Yeah, you mentioned Franco-Nevada because I also like bigger players because of dividends as well. But you are mostly on the royalty side, like Wheaton Precious Metals. By the way, I am not a financial advisor. We're just talking what works for us here on this channel. I do like Franco-Nevada play as well. I'm a holder of Rio Tinto. I like a little diversification in case we don't go through some major depression. But I think that the supply shock is going to be the one that drives all these metals up as well. Real quick before we finish, what are your thoughts on the supply? Are we going to see supply shock, or you're going to see the metals rise just because of everything geopolitically that's going on with the monetary policies, fiscal and monetary?
A lot of the commodity space, the industrial commodities, energy, base metals, even agriculture, there's two things. They do have an apparent supply. Supply is pretty tight across the commodity producers, and also they're pretty cheap. They've been kind of underperformers for a long time, and they're pretty cheap. And so I think there is a lot of upside potential there, assuming a certain amount of regular economic activity. Now, if we all sitting around doing nothing because we can't use our bank ATM machines, demand for copper is probably not going to be very high, or gasoline for that matter. So there are those kind of issues. But yes, I think a lot of the commodity space is pretty interesting here, and I think you can, if you take both that into account and also some of the broader monetary economic factors into account, then you can, according to your own inclinations, set an allocation of your portfolios toward the commodity space, precious metals or industrial commodities, that you can be pretty happy with. Might be 20 to 30%. That's just a number I might throw out there. So something to think about.
Got it. Well, where can people find Nathan Lewis these days? You are on Twitter. I know that. Can you tell us a little bit where people can find you in case they are interested in finding a little bit more about you?
Yes. My website is newworldeconomics.com, and it's got links to all my, it has my Twitter addresses. It's got links to my books, and it's got some, most everything ends up there one way or another. So newworldeconomics.com.
Got it. And I will also find that video from Kitco. I will paste and copy. I think a lot of people need to listen to that one, because I know it was a loaded question. What is inflation? And your stance on that, I found, like I said, very interesting, is why, again, I was very pleased that you decided to come on the show. But I would like to maybe have you back on at some point down the road, maybe second part of this year or next year, to see how things are going. But for our listeners, when you wanted to see Nathan's take on inflation, and he's been spot on, I will copy and paste Kitco's interview, and you guys can take a listen and see yourself what I'm talking about. So happy St. Patrick's Day, Nathan. Hope to see you soon, and I really appreciate your time.
Thank you. It's been fun.
Thank you so much, and we will talk soon. We are out. All right.
There we go.
All right. Well, that was right about 20, 25 minutes. I know, like I said, if I ask you the question, what is inflation, we would have gotten maybe 30 minutes just into that, because I really wanted to get to the point a little bit more on the Fed and what you think about the rate hikes and all that. So I thought it was perfect. I will post it today, most likely, and I will just have you on Twitter. I'll what is it called? Copy, paste you as well, and you will see it.
Super. Well, thanks for having me on.
Thank you so much, Nathan, and I hope to see you soon. Take care.
Bye-bye.
Bye-bye.